Module 2.2 NPV or Net Present Value. This module has two learning objectives. What is the net present value and how to use net present value for stock investing. Being a college student was a great experience for me, but it was also very frustrating from time to time because everything was so different from what I was used to. Whenever I took a new class, I felt I was learning an entirely new language because I discovered so many new concepts that I never heard about before. As time progressed, I realized that the concepts introduced to me were pretty simple, and I shouldn't let the advanced formulas and fancy terminology intimidate me. Today, as a college professor, I'm now the one teaching the students the same formulas and concepts, but I'm also very cautious about not teaching in a manner that just sounds academic for the sake of being academic. Therefore, you'll see a little math here and there in this course, but I always focus on the applicability for you as the stock investor. So in this lesson, I'll give a breakdown of the concept of net present value, also simply called NPV. The equation looks like this. Yep, to me, whenever I saw that the first time, that was completely discouraging. And I thought I would never learn how to find the net present value. If anything, I wasn't even completely sure what the net present value was in the first place. Okay, let's start from the very beginning and return to the formula at the end of the lesson. What is NPV or the net present value really? Well, in valuation, we already several times in this course found that the intrinsic value of a stock is the discounted value of all future cash flows. In other words, if you estimate the net present value of an asset, for instance a stock, you also have the intrinsic value, which is what the course is all about. To illustrate the concept, I would like to show you how to calculate NPV in Excel. For this example, I've made some assumptions about the cash flows. Year 0 is now, so when we have a cash outflow, you have a given investment made today. For instance, you'll be paying $50 for one stock of that company. The cash inflows you see here from year 1 to 5 is the free cash flow from that share. As we know, if you're a shareholder, you will not only be entitled to the free cash flow in the next 5 years, but for as long as you hold the stock. Therefore, in Module 3, we not only show you how to estimate the future cash flow, for instance, how do we know it's $14 in year 1 and $15 in year 2, in Module 2.4 already, we'll also show you how to calculate the cash flows when you hold the stock indefinitely. If we add the number of positive cash flows together, we get $73. But as we learned in Module 2.1, we'll need to discount our cash flows to calculate what they're worth today. The reason why we discount them back to today is that we're making the decision today whether or not to invest in that particular stock at that specific price and whether or not it's profitable. In this example, I've chosen a discount rate of 8%. As we learned in lesson 2.1, choosing a discount rate of 8% is an indication of a very stable and profitable company. If we discount that $73 back to today, we end up with the present value of $58.29. In other words, this is what $73 is worth today given inflation, opportunity cost, and the specific risk for the individual company. As an investor, you should therefore be completely indifferent whether you receive $58.29 today or $73 distributed over the next 5 years. Note that if we increase the discount rate, the present value of the future cash inflows drop accordingly. This is also why you should be willing to pay more for a high-quality stock with stable cash flows. Since the income can be expected to be stable, we'll discount them with a lower discount rate, and the value today, therefore, will be higher. The net present value in our example is $8.29. As you'll likely have already seen, it's the same as the present value when you include the negative cash outflow you have from buying the stock in the first place. If we take a closer look at the formula and redo it, you'll see that it's created as equal to NPV. And whenever you type in a function in Excel, you'll get a brief explanation like this. And what you then do is to type bracket start, and Excel will ask you about different information. First, it asks for a rate, which is just your discount rate. You select that and you type in semicolon. What you can't do is to select each year starting from year 1 in your Excel sheet. But to save time, you can simply select whatever range of numbers you have and then end the bracket. Now you're ending up with $58.29. But wait, shouldn't you be ending up with $8.29? We need to include the cash outflow that will then be added to the value since it's a negative number. Note that you can't just include the entire series of numbers. If I type in the formula again, and select all the numbers, including the cash outflow, I come up with a completely different net present value. The reason for this is that the cash outflow is discounted by 8%, which would be misleading, and the first cash inflow will be discounted by 8% twice instead of only one. In other words, Excel doesn't look at how you formatted your sheet for years, it simply discounts the very first number you select with your chosen discount rate. So what does all this mean? Well, it means if we buy a stock for $50 and it has the cash inflows we saw before, the expected value of that investment today is positive, giving an 8% discount rate. In other words, you should go ahead and buy the stock. So this example was for a stable company. What if it had been a company projected to grow a lot in the future, but perhaps the balance sheet wasn't solid, so you would as an investor incur extra risk? Well, if we replace the cash inflows with growing numbers, the investment might look appealing. But again, instead of 8%, you might discount the cash flows with 13% or even 17%. And as you see, the NPV might not seem as appealing. The lesson has shown that NPV calculations are a lot simpler than the equation we saw in the beginning, right? As promised, I would like to break down the formula for you. T is simply a mathematical way to express a given number of periods. In this example, it would be 5. So in our 5 periods, we have 5 different cash flows. That is what C means. And those cash flows are all discounted by our discount rate, T times, or 5 times if you like, with different magnitude since the cash flow from year 1 is discounted less than, for instance, the 5th period. Note that we need to add 1 to our discount rate since the numerator would increase if we divided it by a number less than 1. The sigma symbol simply means that we'll add all of the cash flows together. In this situation, it's 5. Finally, we'll subtract our cash outflow.